Hello everyone and welcome to another one of my projects. This one is aimed towards beginners and it is on crypto trading, since I've seen a lot of people want to get into cryptocurrencies and into trading but don't know how to actually do it. So first of all, my name is Ilya, better known as CryptoNap, and yeah, let's move on. So what will we do today? So first of all, we will look at the definition of trading. So you will learn, or we will learn together, what trading is. We will learn the difference between buying and selling, longing and shorting. You may not have heard about the longing and shorting, but we will cover that as well. We will also make a difference between investing and trading, because most of the people actually use these use these terms interchangeably, but they are definitely not interchangeable. There's different analysis going into these two, and they are a whole lot different than many people think. Then we're going to look at what technical analysis, fundamental analysis, and sentiment analysis are. And lastly, we will of course learn some new terms, and that will be about it for this session. So first of all, what is trading? Now, cryptocurrency trading, since we're focusing on cryptos right here, so crypto trading is frequent buying and selling of a certain cryptocurrency. Now, if we were talking about trading in general, it would be any asset, any commodity, any currency. Right now, it's only about cryptocurrencies. So, as we said, it's frequent buying and selling, and depending on how frequent it is and how long we stay in a position, um, we can actually differentiate four types of traders. So what do I mean by the length or the duration of the position? First of all, what is a position? It means from the point of your buying or selling. So once you have your position, it's called so when you want the price to go up or to go down, you have to buy or you have to short sell, which we will cover later. And once you actually invest your money into that buying or short selling, you are in a position. Now, depending on how long that position lasts, we can be a scalp trader, a day trader, a swing trader, and a position trader. So first of all, scalping or scalp trading. This is the most well. These require a lot of actually fast trades, and these are usually not done by humans. These are usually done by machines. Um, these are positions that stay in for a certain amount of seconds or minutes. So those are very short trades that are aimed of basically getting that small percentage many times over. Now we have day traders. Day traders, many people are actually aspiring to be day traders, and that is okay, that is certainly decent, but it takes a lot of commitment, and day trading is definitely not a part-time job. So day trading is definitely not a part-time job because it takes a lot of looking into your charts, a lot of analyzing, and it's all about that one moment when you can buy. So it's very hard and it's very time consuming. Day traders are usually, well, that's why they're called day traders. Day traders are not holding their positions longer than one day, or they're not holding their positions overnight. Now, if we have stock markets usually close. So they have a start and they have an opening time and a closing time. Now cryptocurrencies, they do not. So what day traders, what day trading means in here is a bit different than what it means in stock market trading, let's say, because there is no start and no end to a cryptocurrency trading day. But let's say we can actually associate day trading to holding a position that day traders are not holding a long or a short position overnight or when they go to bed. So they are there until they are there. When they leave, their position leaves with them, and that's it. Now, swing trading is a bit different. Swing trading is actually trading that takes a certain amount of days or weeks. It's a bit less technical, so you don't have to look at charts that much, and it's a lot more fundamental. And then we have, of course, position trading, which takes several weeks or even months. Now, position trading can be associated with investing because it's a very long time while you're holding a position. Um, but now there are differences that we're gonna talk about because position trading is, again, as every form of trading, there to make a percentage gain and for us to leave the position, while investing does not necessarily need a stock, or in this case a cryptocurrency, to rise in value. That's not really an investment. So excuse me for a second. Then where can we actually trade? So we're gonna talk about that a lot in the next session, but right now we have two types of places that we're gonna trade. So first off, there's going to be regular exchanges, which just make us trade our fiat currencies, so dollar, euro, yen, or whatever, into cryptocurrencies, or they're going to make us trade one cryptocurrency into another. And then you have BitMEX. Now, why is BitMEX special? So, BitMEX is the highest volume exchange. Well, if we're talking about regular exchanges, Binance is the highest volume exchange, and volume just means how much money is transacted during a day, week, month, year. So Binance is the biggest, but then we have BitMEX, which has more volume, but it's not all real volume because they're gonna offer leveraged positions or margin positions, which means that with $1,000 you can actually enter a position that's up to 100 times more than yours. We're gonna talk about that later. This is just an overview. Then we're gonna talk, well, we should talk right now about profits when you're trading and about the 90% rule. So first of all, many people are expecting these grand profits, these Lamborghinis, big houses, permanent vacations, and things like that. Now, it's definitely not like that. I mean, first of all, this is a place where you devote your capital and then you get returns. So without a good investment, so without a good starting bit of or amount of money, you're not going to get anything. Also, there's a 90% rule which is hovering around. I'm not sure if the statistic is right, but it sounds very right. And it's basically claiming that 90% of the people lose 90% of their money in 90 days. So I mean, that's a real eye opener. It means that as with any business and as with any job, you actually need to know what you're doing. You need to devote yourself fully and to immerse yourself in the crypto markets in order to actually profit. And I mean, why would it be any different than with any other job? I mean, it involves money. It People are trying to make some money, to create some value, and that's about it. I mean, why wouldn't people fail? 90% of startups fail when we're talking about business. Why wouldn't the 90% of the people that are starting in cryptocurrency trading fail as well? I mean, that's simple math. Now, what we are interested in is becoming uh, a member of the 10%, right? We want to learn as much as we can. We have to fail. Like, don't be afraid of failing. I actually encourage people to fail because failing is a part of the thing. And it's one thing to fail while trading without money, and it's a whole nother thing when you're failing, when you're actually devoting your money, because you have emotions playing out, and this is a very emotional game. Because people are emotional beings. Actually they cannot exclude emotions from anything that they're doing. And when you're devoting a certain amount of capital, you're exposed to major gains and major losses. Now, of course, we can manage the losses, we can manage the risk that we're playing with, but of course there's going to be emotions involved. And now we have to talk about the speed of the markets. So, as far as that's concerned, now many when we look at stock markets, we can look at the most famous index in there, which is S&P 500, and that is 500 uh, top companies in the US and their index, so their average. Now, the average gain per year of that index is 8 to 10%. Now, let's look at cryptocurrencies. How much did Bitcoin actually gain last year? How much will it gain this year? How much did it gain 2 years ago, 3 years ago, 7 years ago? These markets are moving so fast. And cryptocurrency markets are, let's be honest, one of the youngest markets. They're not as regulated as anything else. They have a lot of risk potentials. They have scams. Um, they have some people that are trying to take your money away. But also, it has such a great gain potential. It's such a revolutionary technology, and it offers so much to people who are immersed in these crypto markets, especially when trading, because you can see the moves easily. Well, when you know what you're doing, you can see the moves in crypto markets and in stock markets and in futures markets, depending on what you're trading. But in here, the trades actually unfold so much faster, and it just makes if you're good again, it makes the amount of time you need to gain much money uh, a lot less. So you need less time to gain more money because the markets are faster. Now, moving on from what trading is, we can look at what can we do while we're trading. So we can buy and sell, of course. Buying simply means that we are buying a cryptocurrency. Selling means that we are selling a cryptocurrency that we already have. Now, we have two terms that many people don't know that have not traded yet, and those are longs and shorts, or longing and shorting a cryptocurrency. Now, longing just means buying. Those are interchangeable, so you can use both buy and long. Those two mean the same. Now, as far as selling and shorting, which is also called short selling, is, well, they can be the same and they can be interchangeable, but not every time. Now, what does this mean? Selling usually means that you are selling a cryptocurrency that you already have, while shorting means that you don't have any cryptocurrencies, but you can enter a short position, which means that you are betting that the cryptocurrency will go down in price. Now, how does that work? Short selling is basically not a very difficult concept to understand, but kind of a difficult concept to explain. So let's say we're trading on Binance. Well, we can't actually short on Binance. Let's try trading on BitMEX, and we want to short Bitcoin. It means that BitMEX is borrowing us Bitcoin, and we're selling Bitcoin immediately, and then we are rebuying it at a certain price and returning it to BitMEX. The net gain or the net loss will be our loss. So that is short selling in a nutshell. Now it's way easier to just think of it as betting that the price will go down, because you don't actually do any of the borrowing, selling, buying back, and returning that we were talking about. You're actually just entering a position. It's, instead of a green position, it's a red position. It says short, and you gain money when the cryptocurrency is going down instead of when it's going up. You are realizing those gains, and you're actually having a gain once you close the position, and that's it. And also, we have a question that many people who are looking at day traders, they're asking this question a lot, and that is, how many monitors do you need? Because they saw all those day traders with 4, 6, I don't know, 7 monitors. They're looking they're looking at all sorts of things and everything. You don't need those, so you only need really one monitor. You can fit everything inside your one monitor screen, and that is completely perfect. So you don't need to spend any money in the equipment, in the hardware. All you need to do is learn how to trade. And that is not an easy task, but it is a manageable task. Now, what we have in here is the difference between investing and trading. So first of all, we have to think about what those two terms mean. So we've explained trading already, that trading is high frequency buying and selling of a cryptocurrency. Now, investing is the opposite. Investing is putting money into a cryptocurrency and leaving it for a year, 2 years, 5 years, 10 years. And we actually don't care what the price is. So, first of all, we have the position duration, which is much longer in investing than in trading. Then we have the care for current prices, as I've said in here. And that means that when you're investing, you care less about the current price. So you don't really know. I mean, you can analyze and you can see if the price of a cryptocurrency is undervalued, overvalued, or at the approximately right price. But when you're investing, you don't actually care about that. You care about the potential, the future potential. So you are investing in something because you believe that it will change the world, and then it will increase in price over a long period of time, and not that it will increase in price in the next day, week, or month. So that is investing. Now we have different analysis, of course, because you're not looking at the same thing, you're not going to analyze the same thing. Trading is usually mostly um, analyzing a stock technically. So going to a chart, you're using those indicators, and you're making a decision based on what the indicators tell you, and you're actually entering a trade. When you're investing, you're looking at the fundamentals, and that means what is the idea? How is the idea going to be handled? What's the team behind it? How are they going to handle it? So you're looking at the bigger picture in here. While when you're trading, you're looking at a really small frame. You're just caring about the momentum that's going to happen. And then, of course, you have the different styles of, I mean, trading and investing are definitely different styles of putting your money into something. And trading is a much easier way to lose your money, but trading also has higher potential profits, while investing will definitely have lower profits. Let's say a professional investor will have less profits than a professional trader, but investing is much safer, and it can be considered um, a part-time job, or you can just look at something, be a bit knowledgeable, and then invest in it and hope for the best. While when you are trading, you have to be fully immersed into it, and you don't have time to slip up and to actually do bad. As far as analysis goes, when trading when trading is well when we're talking about trading, we have technical analysis, fundamental analysis, and sentiment analysis. Now, trading is mostly focusing on technical analysis, which, as we said, is looking at charts, putting indicators on charts, and then predicting where the price will go based on the patterns that we saw. As far as chart analysis and technical analysis goes, we're going to cover that in 2 sessions, so in our third session. Of course, this is just the basics, so this session is only covering what it all means and how we can look at it as a whole, so how we can look at trading as a whole, and we're not getting in depth at any of the analysis yet. Of course, you have to be patient since this is a very sensitive subject. Now you have fundamental analysis, which is, again, as I said, an analysis of the fundamental concepts. So the idea, the partnerships, the team, or whatever the project has. So that is the fundamental analysis. We also, in the fundamental analysis, have market acceptance or market traction, which means um, how many people are supporting the project. We have the let's say SEO, if we're talking about some ICO or some new project. So how many visitors there are on the website, or how long have they stayed, have they interacted with the website, or have they just left, which is called a bounce rate. So we have a lot of things in the fundamental analysis that we can look at. Of course, in the technical analysis, I don't want to go into indicators a lot, but we can look at the average price of a certain period. We can look at the how low is the price currently, or how away it is from its all-time highs. we can look at some chart patterns, and we have a lot of them, like flag patterns, like triangle patterns, like head and shoulders. Um, we have Fibonacci retracements, we have support and resistance lines. Again, we're gonna cover that later, but there are a lot of things that we can learn in there. And of course, we have sentiment analysis, which means what is the market saying? Is the market inclined to buy this or to sell this? Is the market thinking that the price is gonna go up or gonna go down? Now, there are two parts, two components to sentiment analysis, and that is looking at smart money and looking at dumb money. So, when you're looking at smart money, you're looking at institutional investments, at the banks, the hedge funds, the investment funds. So these people, or these companies, you're gonna look at that, and you're gonna see the direction. So right now, if you're looking at cryptocurrencies, you see all those institutions coming in. When you're looking at dumb money, and smart money and dumb money are kind of colloquial colloquial wordings towards institutional money and just normal person's money. Now, dumb money means just money of the masses, and people are usually very sentiment driven, and that's what happened with the bubble during December, January of well, December of the last year, and then January of 2018. So that's when the bubble kind of has popped. But before that, let's say 15th of December, somewhere around December, like there was so much hype around cryptocurrencies, and those were not institutions, those were just normal people. For an example, in the time span of 15 days, I received about 20 calls from my friends asking me how to invest in the cryptocurrencies, telling me that they have heard about Bitcoin or Ethereum or any other cryptocurrency and how it's going to be so good and how they're going to earn so much money. They just need a little bit of help. So I started talking about them, and I saw that they have no clue what they're talking about, but they're still devoting their cash into it. And that's when you realize that you have to act with the smart money, and you have to act opposite to dumb money. And that's how I actually exited and sold all my Bitcoin when it was time. So I sold it at around 18,000, and then I rebought somewhere around 10,000, 8, all the way up to, well, all the way down to 6,000. So um, so yeah, I made a lot of gains back then, and it was only because of the sentiment analysis. Now, of course, we're going to look at the last topic today, which is going to be the basic terminology. We've already talked about buying and longing, which are interchangeable. We also talked about selling and shorting, or short selling, which may be interchangeable but also may not be, depending on what we're talking about. And now we have a new term. It's called the order book. Now, what is the order book? An order book is simply you can actually see it in BitMEX or Binance or any other exchange. And it will be a window. It is basically a window comprised of people that are trying to sell and buy um, a certain cryptocurrency at that time, at different prices, of course. And we're going to see how much money is, let's say, buying Bitcoin at 10,000, or how much money is selling Bitcoin at 11,000, or, whatever we have there. Now we're going to look at market buy, limit buy, and stop loss. So when we're actually buying something or selling something, we have different ways to buy it. And the first one would be market buy and market sell. Now, what does that mean? It means that someone already, well, let's focus on Bitcoin for now. So when we're trying to market buy or market sell, it means that someone already is trying to sell at that price, and you're just buying his Bitcoin, or he's trying to buy Bitcoin and you're trying to sell at that price. So you're actually filling his order. So you're filling the order of someone else. Now you have limit buy and limit sell, which is the opposite, which means that no one is buying and selling at that price, but you're gonna put your buy order at a certain price or your sell order at a certain price. When the price reaches that amount, you're gonna get your order filled. Now, this means that you can get your order filled fully or you can get it filled partially, depending on how many people are actually buying or selling at that time. And you also have a stop loss. And stop loss is something optional, but it is a very valuable tool when you're trading. So what happens is you're going to enter a position. It doesn't matter if it's a long position or a short position. So you're entering some position and you want a cryptocurrency to go up or to go down. Now, what happens if it goes the opposite way? So you're starting to lose money. You can actually set a stop loss, which means that you will automatically exit a position at a certain price, and it will prevent you from further losing money. So that is what stop loss is. Now we also have liquidation, which is a different term, but is very connected to stop loss. So before covering liquidation, we have to cover leverage and margin. Now, we already talked a bit about it, but both leverage and margin means that when you devote a certain amount of capital, you can get matched with a certain amount by the exchange. And that's what BitMEX does. So if you, let's say, have $1,000 on BitMEX and you want to trade with $1,000, you can actually enter a trade with 100 times more than what you have. Of course, if you're entering, so that's called leverage, and that's called 100x. Now you can enter a position with exactly $1,000 that you have. So if the price drops $1, you're losing $1. But if you're entering with 100x or with 100 times leverage, if the price drops 1%, you're gonna lose all of your money. And when you lose all of your money, that is called liquidation. So when you're using leverage or margin, you cannot go below what you actually have. So you cannot go into debt. You cannot owe the exchange anything. So you can only lose as much as you have, but you can actually use their money to gain more. So when you're entering your leveraged position, they're actually going to give you a liquidation price, which means that if a price reaches that point, you have lost everything you have. And that brings us to position sizing, which means how much you're actually going to invest and how much leverage you're going to use in order to have a normal liquidation point. Now, you will do that. You will actually estimate your liquidation. They will tell you your liquidation point, but you will estimate where it will be based on your technical analysis, which we're going to talk about later. And then we have market depth. And what is market depth? You can see it pretty well because on BitMEX, because they have a pretty nice market depth. Well, a pretty visible market depth, and that is basically it will look like two colliding mountains, and then one mountain would be the buyers and one mountain would be the sellers. And how high the mountain is means how much money it goes into buying or how much money goes into selling, and that would be an indicator of what are the people doing at the moment. Are they mostly buying or are they mostly selling? So I understand that this basic terminology will not click with you, even though it's basic. It will not click with you yet, and you will mostly not understand what I'm talking about yet. But hopefully by the end of this project, you will understand everything, and then we can actually start with the intermediate. Intermediate classes, where we're going to learn how to actually trade, how to analyze, and how to enter positions. So I would like to thank you for listening to me and for listening to this session. I will be back with you shortly, and yeah, I'll see you soon, guys. This was Ilya, better known as CryptoNap, and have a nice day. Bye bye.